Joining us on the CNBC Newsline, New York Times reporter and CNBC contributor Kate Kelly. Kate, always great to see you, though a sad occasion today. You've, of course, covered Mr. Cayne and Bear Stearns very closely those decades ago when Bear was still around. He was a titan of Wall Street and of the old school of Wall Street also.
That's right, Wilf. He was a really unique character. Just to share some memories about Jimmy Cayne, he really grew up in the Wall Street business through his time at Bear Stearns. He was a private client services broker, and he really loved schmoozing with big clients. Before doing that, by the way, he had sold photocopiers. He had driven a cab. He had played bridge for money. He continued to do that, but he had a series of odd jobs before joining finance. And Bear was a place where they hired what's known as PSDs, poor, smart, and with a deep desire to be rich. And Cayne fit that mold very much. He rose his way through the ranks and became CEO, as you mentioned. He was actually the first CEO on Wall Street to have paper wealth worth $1 billion in the market. This, of course, was in the mid-aughts before the financial crisis hit. Bear was making $1 billion by that time. It was known for its fixed income trading, its origination of mortgages, its securitization of mortgages. It had a huge fixed income business, but also a very successful equities business. It was a place that trained the likes of David Solomon and John Waldron, who are now the #1 and 2 at Goldman Sachs today, among many others. Jimmy, though, was a unique character. He had a love of bridge. He had a love of golf. He didn't like to get those things in the way of work too much. During his latter year or so on the job, and probably for many years before that, he would often leave work on a Thursday afternoon by chopper, go play a round of golf, play another round in the morning with no cell phone. This was like 2007, a time when you actually could do those things. It seems unimaginable now, but he had a love of his leisure pursuits, and his bridge actually brought in a series of clients earlier in his career. That's how he met some key people. He had a dislike of traveling. He liked to host people in his office, which was kind of a cozy, comfortable, almost like lounge that was dimly lit. He had 2 assistants outside. He would puff on a cigar, offer his guests some very fine cigars, put his feet up, and he could talk about everything from local politics to the scrap metal business. He had sold scrap metal at one point in time. So he really was a colorful character, Wilf. He hated to travel, and he used to say he hated to be on the board of the New York Stock Exchange because he didn't like to travel from Midtown, where Bear Stearns' offices were, to the exchange downtown.
The other thing, I guess, Kate, that he was responsible for, though, the business he built expanded more once it was part of JPMorgan, was traditionally very much a trading firm, and he broadened that out to full investment banking services.
That's right. He broadened the firm, and he did so, by the way, with the help of Alan Schwartz, who's still active on Wall Street at Guggenheim Partners, and also with Warren Spector, who's now retired from that business but helped build the fixed income side of the business. Alan, of course, the consummate investment banker. And they definitely worked with major clients, Verizon, Disney, and many others, Lawrence Tisch from CBS back in the day. So that was definitely a key part of their offering by that point in time. But I would say they were best probably known for that equities and also that fixed income business, as well as the private client.
And, of course, JPMorgan bought Bear Stearns at the peak of the crisis, a deal alongside their acquisition of Washington Mutual that Jamie Dimon has said in various interviews over the last decade that he wouldn't do again. That said, whether it was quite costly for them in the short term with various fines and other capital requirements, they probably wouldn't have the scale and depth of investment bank that they have today if they hadn't acquired Bear Stearns.
Well, I think JPMorgan has been building its own investment bank organically for many years, although to be sure they've gained some strong players from Bear Stearns. I think what JPMorgan especially gained in that Bear Stearns acquisition, and Jamie's right, I mean, there have been heavy liabilities resultant from the financial crisis and some of the inventory that Bear Stearns brought to JPMorgan. Jamie's right in the sense that it may have ultimately cost him money in that sense, but he did gain talent. And one thing he gained was a really strong prime brokerage business. Bear Stearns was really strong in that, and some of those key players went to JPMorgan and are still there operating the business under the JPM shingle. So they gained expertise from a number of people. And, you know, Bear Stearns talent has populated many other firms. I mentioned the top of Goldman Sachs, but also those folks have landed at Bank of America Merrill Lynch. Those folks, as mentioned, have landed at JPMorgan and every other bank on the street. It was a tight and strong culture. And those that came out of it remember it well. When I wrote my book about Bear Stearns, which is Street Fighters, which was an outgrowth of some reporting I did at the Wall Street Journal about the fall of the firm, I was struck by the strong memories and really fraternity, women too, but fraternity among the people that worked at Bear. They still keep in touch, many of them. They still keep up to date on every little thing. I recently got an email from a retired Bear Stearns fixed income guy who had been tossed off of the Ghislaine Maxwell jury, believe it or not, because he had known Jeffrey Epstein when Jeffrey worked at Bear Stearns.